Southwest Airlines was once an emblem of innovation and resilience in the American airline industry. Born from a sketch on a cocktail napkin in 1966 at St. Anoni's Club in San Antonio, Texas, the brainchild of entrepreneur Rand King and his lawyer Herb Keller aimed to connect the Texas Triangle, San Antonio, Dallas, and Houston, with affordable, efficient air travel. What began as a modest intrastate carrier grew into a titan, becoming the fifth largest airline globally, surpassing giants like Lufthansa in passenger numbers and American Airlines in route offerings. By the 2010s, Southwest boasted a 20% profit margin, a rarity in an industry where single-digit margins were the norm, while maintaining a reputation for customer-friendly policies like free checked bags, open seating, and stellar service. Yet, over the past year, this beloved institution has undergone a dramatic transformation, shedding its egalitarian ethos under pressures both internal and external. This is the story of how Southwest Airlines rose to greatness and faced a reckoning that altered its very identity. The rise of a maverick Southwest's ascent was no accident. Leveraging Texas's unique geography, large enough to make driving between cities inconvenient yet contained within state lines to avoid federal regulation, the airline carved out a niche. Free from the Civil Aeronautics Board's oversight, Southwest set its own fares and schedules, undercutting competitors like Braniff and Continental, who fought its entry with lawsuits costing nearly $500,000. Undeterred, Southwest launched in 1971 with 3 Boeing 737-200s, adopting a point-to-point model that prioritized efficiency over the hub-and-spoke systems of its rivals. Strategic decisions fueled its growth. Initially targeting business travelers, Southwest stumbled into a lucrative leisure market with discounted weekend flights, pioneering a 2-tier fare structure that became a cornerstone of its low-cost model. Staying at Dallas's Love Field, closer to the city center than the new Dallas-Fort Worth International Airport, reinforced its customer-centric identity. The airline embraced the Love branding with warm colors, a heart logo, and a playful tone, making flying Southwest an experience, not just a transaction. Over decades, it expanded beyond Texas, acquiring carriers like Muse and AirTran, and by 2017, it celebrated 45 consecutive years of profitability, a $3.5 billion net income, and a spot among Fortune's most admired companies. Southwest's success wasn't just financial. Its no-layoff policy, profit-sharing program, and internal promotion culture, exemplified by CEO Bob Jordan's 37-year rise from programmer to leader, created a loyal workforce. This ethos, rooted in Keller's moral vision, became a competitive edge, ensuring happy employees delivered exceptional customer service. Southwest wasn't a budget airline nor a full-service carrier. It was a unique hybrid that thrived by doing things differently. Cracks in the foundation. The COVID-19 pandemic tested this model, but Southwest weathered it better than most. Its narrow-body fleet and domestic focus capitalized on the resurgence of leisure travel in 2021, launching routes to places like Telluride and Palm Springs while maintaining its no-layoff stance. Yet, the real storm hit on December 21, 2022, when Winter Storm Elliot plunged Denver's temperature from 42 degrees to 5 degrees in an hour, bottoming out at 24 degrees overnight. At Denver Airport's Terminal C, Southwest's operations unraveled. Unlike competitors using enclosed desing rigs, Southwest's cost-saving open basket rigs faltered in the extreme cold, requiring frequent staff rotations to prevent frostbite. Half its flights canceled, while others faced massive delays. The airline's SkyOver software, meant to manage disruptions, exacerbated the crisis. Designed for minor issues, it took 25 minutes to propose solutions, too slow for a fast-evolving storm, and couldn't address past-due flights, leaving humans overwhelmed. The point-to-point network, once an asset, amplified the chaos, with cancellations in Denver rippling to Honolulu. Crews were sent on nonsensical routes, and the airline lost track of their locations as its hotel desk buckled under the strain. By Christmas, Southwest canceled 2/3 of its flights, operating empty planes to reposition resources. The meltdown, lasting over a week, saw 15,000 flights axed, costing $400 million in lost revenue, $600 million in compensation, a $140 million DOT fine, and $300 million in future booking losses, nearly $1.5 billion in total. The damage to its reputation was incalculable. A financial predator emerges. As Southwest reeled, its financial fortunes waned. Profits dropped from $1 billion in 2021 to $539 million in 2022 and $465 million in 2023, bucking the industry's post-COVID boom. Rising fuel costs, pilot shortages, and severe weather strained the low-cost model industry-wide, but Southwest's outdated technology and reluctance to modernize left it vulnerable. In June 2024, Elliot Investment Management, a notorious activist investor, seized the moment, buying an 11% stake worth $1.9 billion. Elliot saw Southwest as a faltering giant ripe for restructuring. Targeting Jordan and executive chairman Gary Kelly, the firm demanded their ouster, arguing the airline needed a radical shift to boost shareholder value. Southwest resisted, but Elliot pushed for a special shareholder meeting to overhaul the board, converting derivatives into common stock to meet the 10% threshold. The airline countered with a poison pill plan, allowing other shareholders to buy stock at a discount if Elliot exceeded 12.5% ownership, diluting its influence. A forced transformation. The battle unfolded amid public backlash. To appease Elliot and regain trust, Southwest abandoned open seating for assigned seats with premium options and began charging for bags, moves that boosted revenue but betrayed its loyal base. Elliot, unsatisfied, proposed a board slate with airline veterans from Virgin America and Ryanair, clashing with Southwest's insular culture. Behind closed doors, Kelly met with Elliot in New York, leading to a compromise. Kelly's retirement was fast-tracked. 6 board members stepped down, and 5 Elliot nominees joined a 13-seat board, with Jordan staying as CEO. These changes marked the end of Southwest's fairy tale era. In February 2025, the no-layoff policy was scrapped, and the board, now outsider-heavy, drifted from the Keller ethos. Customers faced higher costs and fewer perks, while employees mourned a diluted culture. Elliot's logic that mimicking profitable rivals would save Southwest may yield short-term gains, but at a steep cost. For nearly 50 years, Southwest's unique value proposition, low fares, simplicity, and goodwill, set it apart. Now, it competes directly with giants like Delta and United, its cult following eroded. The aftermath. When Elliot eventually exits with its profits, Southwest will emerge diminished. Its competitive edge and brand, built over decades, have been sacrificed for a conventional, profit-driven model. Customers and employees bear the loss, while Elliot moves on to its next target. Southwest's story is a cautionary tale of how external forces can dismantle a beloved institution, leaving behind a shadow of its former self in the relentless pursuit of shareholder value.